With regards to investing in the stock market, let's start really from the beginning to understand what exactly is a stock or a share. What happens when you actually buy something like that? So let's start way from the beginning. So first of all, imagine a firm has been created from scratch. So you might be an entrepreneur, you might create a business from scratch, maybe with yourself, with friends, etc., whatever the case may be. So at the beginning, a firm is incorporated and there are owners or one particular owner. It's simple as that. Nobody else in the outside world can buy a piece of that company, buy a share of that company. There is only one or more founder owners. The shares of the company are not traded on an open market. Simple as that. So that's how it all starts at the beginning. At some point, the firm may grow and the owners may decide that they want to bring in outside investors partially, or maybe even sell up their stake completely and sell the shares of the company onto the open market. So this could be a stock market, a regulated stock market, such as we find the London Stock Exchange, New York Stock Exchange, NASDAQ, etc. So at this stage, what's happened is a company which has been privately owned by founders or other people now is floated onto the open market, and complete strangers who have had nothing to do with building the business, establishing the business, etc., can now purchase a share in that business. So this is what happens. We start from a privately owned company, owned by the founders initially, potentially owned by backers, and then eventually floated onto the stock market and owned by strangers who had nothing to do with the initial establishment. Okay, so that's how you become a shareholder. You buy shares in a company and you effectively become a part owner. Now, if a company is valued, let's say $1 billion, £1 billion, you may find that there could be 1 billion shares in circulation because the founders don't want to sell the whole company outright. They want to just sell it in small pieces. So if the firm is valued at $1 billion, you might purchase shares worth, say, $1,000 or $2,000. So you become a partial owner of that company. And you can see if the firm is worth $1 billion and you purchase $1,000 of shares, you become a micro owner, a very, very small owner in terms of the overall number of shares outstanding. But that's okay. You are still an owner. You still have rights that an owner would have. If the company makes profits and distributes those profits as dividends, then you would have a claim on those dividends and you'd get a share of the dividends, your small percentage share, of course, not the whole dividend, but the small percentage share. You also enjoy the ups and downs of the firm. So should the firm go bankrupt, you would be wiped out, your investment would be wiped out because you are effectively an owner of the firm. So yes, there's ups and downs. It's not a one-way street to glory and riches, of course, as you've already learned. So nevertheless, you do become an owner of a firm. So that's the first thing. Now then, the next thing is, what do you do then? Some people understand this concept of being an owner of a firm, and they actually want to become an owner of the firm for the long term, their whole life, in fact. So if you think about Warren Buffett, he is one of the greatest investors of all time, and he thinks like this. What he does is he says, okay, I found a really good company here. They've got a compelling product. The market share is great. The management is great. Everything about the firm is fantastic. The customers love the firm's products. This company has long-term legs. It's going to last for a very long time. So Warren Buffett, what he does, he'll say, okay, I want to invest in this firm, but he really will think about it from a owner's perspective. So given that he's super rich or his firm is very rich, he may end up buying the entire firm or a controlling stake, but not always. Sometimes he'll just buy a large stake, maybe 5%, 10%, etc. So it becomes a part owner. So Warren Buffett's ethos is, I'm going to buy this firm and hold it forever, pretty much. He doesn't have a exit point, an exit date, or anything like that. He may exit if the firm goes backwards, goes downhill, and there's problems. But in the main, he's saying, okay, Where I am now, what I understand of the firm, I'm going to own a part of this firm and I'm going to own it forever. So think like an owner, just as you would do if you were creating a firm. You wouldn't be thinking of selling it on a Friday, buying it back on a Monday, selling it on the Wednesday, buying it back on the following Friday, etc., etc. You would own it over a long period of time. So that's what some people do. They own the firm pretty much over a long period of time. Other people, however, don't want to do that. They want to own it for a period of time, which might be 5 years, 10 years, 20 years, or until they retire, whatever that may be for them. And other people don't want to own the firm at all. They don't really care about the fundamentals of the firm. They are just trading the share price. So they will buy one day, sell at a higher price within a few hours or a few days or a few weeks, maybe a couple of years. But the intention is not really to think like an owner. All they're trying to do is buy low, sell high, buy high, sell higher, etc., and avoid obviously the loss on the other loss if things were to go wrong. So you can see the difference in mentality, the dichotomy here. One group of people, the Warren Buffett types, want to own the firm forever. They want the management to be settled. They want the management to just get on with the work and not be bothered about short-term fluctuations. They want to see long-term steady growth. And they accept that there's up and down periods within a 5-year block, for example. So they are long-term investors. So this is a distinction I want to make for you, is the difference between trading and investing. So the two words that you've probably heard a million times. People switch between them synonymously. They think trading is investing and investing is trading. It can be, it just depends what meaning you attach to it. So my meaning, which I think is a commonly used meaning, is trading is literally short term. You're not that fussed about the company's fundamentals. You just want to trade the price. So basically buy at one price, sell at a higher price, lock in a profit, and avoid buying at one price, selling at a lower price, and incurring a loss. Investors, on the other hand, are not interested in buying and selling the firm. They want to own the firm and they want to benefit from the share price gain, so that eventually when they do sell, their assets, the money they've invested is worth more than they started with. And also, if the firm is profitable, they want to enjoy the dividends that accrue from owning those shares. And they just want to own part of that firm. They want to lock in their money, put it in a place where it has a long-term growth potential, better than holding money in the bank. And yeah, that's how they hold their wealth. So make that distinction. When you are investing, think to yourself, am I holding this for the long term? Am I going to hold this like an owner? Am I going to be agnostic to the fact that stock markets and economies are cyclical and go up and down? Do I believe in this firm in the long run and not be put off by the fact that there's a little correction in the stock market and the share price may have fallen by 10 or 15%? Or am I going to think like a trader, where preservation of capital is more important? I'm not thinking in the very long term. I don't want to tolerate a 20, 30, 40% drop in the share price. Am I going to put enough stop losses to make sure my losses are minimized? So understand who you are in relation to that particular investment or trading opportunity. Get really clear on that. So a lot of people think they are investors, but then start trading the share price. Other people think they are trading, but then forget all about the stop losses and risk management and just hold it for the long term. But in between, they haven't quite got that mental capacity to appreciate there's ups and downs, and they will just do the worst thing possible, not have any stop losses, sell it at the rock bottom price when things are just looking horrendous, and probably sell at the wrong time when there's an uptick as well, but it's just a bounce and it goes back up. So be clear on that. In terms of safetiness, risk aversion, etc., it's much safer and less stressful to think like an owner, because when you're trading, you are compressing your time frame of interest. Because if you think about a short enough time frame, maybe a day, it's potentially possible that the share price might go up by 2 or 3% within a day. That's incredible. So if you make 2% per day, and you could do that day in, day out, you would be very rich very quickly. Obviously, we know that's not really possible to do. There are up days and down days. But if you are going to think like a trader, think in the short term, then stick to that and incorporate all of the tools and rules that traders should work on. Conversely, if you think like an owner, you don't have the stress and the pressure of short-term fluctuations, daily fluctuations, weekly fluctuations. You can ride out everything. You can just look at your investments infrequently, not be focused on looking at them every single hour. You can think like the long term. You can say, okay, management's got a 5-year plan. I want to see this work through. I know the economy is cyclical. There's ups and downs, which repeat every 3 or 4 years. I can see that this firm will be able to ride out these ups and downs. So yeah, I think that's my lesson to just leave you with there is understand what it means to invest in the stock market. You become a part owner for a period of time, and then just be clear for yourself, are you a short-term trader or are you a longer-term investor? Because there is a massive distinction between those, as I've explained, and the mindset to become one or the other is very different. You can be both, but don't be both at the same time. That would be a hiding, that would give you hiding to nothing. Okay, that's great. Hope that's good. And yeah, perfect.